The financial world is shaking, and you need to understand why. The chief investment officer of Vanguard, which manages a staggering $10 trillion, just made a bold statement. Stay away from US stocks. Why? Because they are heavily overvalued. The price-to-earnings ratio of the S&P 500 index is defying logic. According to Vanguard analysts, we are on the brink of a bubble that could burst at any moment. Corporate earnings have stagnated, and the forecast for returns on the US market looks grim, especially when compared to the far more optimistic picture abroad. This is not just a warning, it's a clear signal. It's time to rethink where your money is going. And what about the dollar? It is under pressure too. In the year 2025, the dollar's share in global reserves fell to a record low of 47%. In the year 2000, it was 71%, and just a few years ago, 57%. Leading this trend is China. It is cutting investments in US government bonds, and central banks around the world are exchanging dollars for gold. BRICS countries are actively moving away from dependence on the dollar, and this could have serious consequences. When demand for the dollar falls, borrowing costs for the US rise, meaning America's debt burden only gets heavier. What does this mean for ordinary people? A weaker dollar means rising prices for groceries, gasoline, everything. US stocks are starting to lose ground, while European markets are climbing. Add to this the new tariffs from the Trump administration, and we could be facing a serious economic storm. So let's break it down. It starts with what shook the markets. Vanguard CEO Roger Davis did not mince words. In his view, US stocks are overheated and will soon disappoint millions of investors. Over the past 10 years, the S&P 500, which reflects the performance of America's largest companies, delivered an average annual return of 12.4%. But according to Davis's team, the era of easy profits is over. The expected return over the next 10 years is only between 3.8 and 5.8%, averaging around 5%. That's a sharp drop compared to what investors have become used to. So why such gloomy forecasts? It all comes down to the numbers. The price-to-earnings ratio, or PE, of the S&P 500 is currently at 29.3. That means investors are paying nearly $30 for every dollar of earnings. Vanguard also looks at the CAPE ratio, a long-term indicator developed by economist Robert Shiller. According to that metric, US stocks are overvalued by about 49%. Imagine paying $149 for sneakers that are worth $100. That can't go on for long. Meanwhile, corporate earnings are barely growing. From late 2021 to early 2025, earnings per share for the S&P 500 rose from $198 to $217, less than a 10% increase in more than 3 years. That barely covers inflation. Without strong earnings growth, today's high prices look even more dangerous. But there is another important point. If you haven't reviewed your investments in a while, your strategy might already be unbalanced. The classic 60-40 model, 60% in stocks and 40% in bonds, has quietly shifted in favor of stocks over recent years. While stocks were delivering over 12% annually and bonds around 2%, your equity share could have crept up to 80%. That's a big risk, especially if stocks are overheated. The same goes for international diversification. US stocks have outperformed foreign ones by about 6% per year. If you started with 70% US and 30% international assets, you might now have 80% in the US and only 20% abroad. That means most of your money is in the most overvalued part of the market. The S&P 500 is already showing instability, while European markets are up 9% and still climbing. These are not just short-term fluctuations, they are warning signs. Overstretched valuations, weak profits, and jittery investors are making the US market increasingly fragile. And if you're heavily invested in it, Davis believes you are in the danger zone. And Vanguard is not just another voice. It is a giant managing $10 trillion, more than a quarter of all assets in US ETFs and funds. Their index products outperform competitors in 80% of cases thanks to ultra-low fees. The company's founder, John Bogle, revolutionized the market in 1975 by making investing accessible to everyone. Today, Vanguard's message is crystal clear. The US market is overheated, and it's time to reshape your portfolio. Betting on international markets and bonds sounds like a sensible move. It once seemed the market would be a never-ending celebration, but according to Davis, the hangover has already begun. But instability is not just about the stock market. While the US equity market is cracking at the seams, the dollar itself is losing ground. More and more countries are moving away from using it in trade, savings, and reserves. This global trend, de-dollarization, is shaking the very foundations of the global financial system. In the year 2025, the dollar's share in global reserves dropped to a record low of 47%. Back in the year 2000, it was 71%, according to data from the International Monetary Fund. And these are not just numbers. From 1999 to 2019, 96% of trade in North and South America was conducted in dollars. Now that dominance is rapidly fading. Why should this matter to you? Because the fewer countries that want to use the dollar, the weaker it becomes. And this directly impacts anyone who earns, saves, or invests in dollars. According to JP Morgan estimates, this shift could increase US borrowing costs by half a percentage point, or even a full percentage point. That might seem minor at first glance, but with national debt standing at $37 trillion, already more than 120% of the country's gross domestic product, even a small rise translates into enormous sums. Higher interest on debt means higher servicing costs, a growing budget deficit, and a greater likelihood that policymakers will have to cut spending or raise taxes. But the pain does not stop there. A weaker dollar makes all imports more expensive. 1 liter of gasoline could easily cost more than $1.30. Clothing, electronics, food, everything starts getting pricier. Inflation hits everyone, and when it is tied to a falling dollar, it becomes much harder to control. Since the end of the Second World War, the dollar has been seen as the most reliable currency in the world, a symbol of stability. But now that confidence is beginning to fade, more and more countries are questioning whether the United States can still be relied on. This shift undermines the dollar's dominance. This is not just a banking technicality. It is a matter that affects your paycheck, your savings, and your daily life. As the dollar weakens, every household will feel the consequences. And behind this shift stands a force that has both the means and the motivation to challenge American dominance. Today, the main threat to the dollar is China. And it is not just making noise. It is conducting a full-scale financial offensive. Since 2021, China has cut its holdings of US bonds by 25%, from $1 trillion to $765 billion, according to US Treasury data. At the same time, Beijing is actively buying gold. In 2024 and 2025, it added 290 metric tons to its reserves, according to the World Gold Council. The reason is clear: US sanctions, especially the freezing of $300 billion in Russian assets in 2022, severely undermined trust. China is aggressively promoting the yuan in international trade. Through its Belt and Road Initiative, it has signed agreements with 150 countries, allowing the use of local currencies instead of the dollar. In 2024, trade volume with Southeast Asia in yuan rose by 20%, according to Reuters. However, the yuan is not yet ready to replace the dollar. It accounts for only about 4% of global currency reserves. The reason is China's strict capital controls. Still, the strategy is obvious. China is not trying to replace the dollar overnight. It is steadily reducing its influence, shielding its own economy, and strengthening its position on the global stage. If it succeeds, the United States will face higher borrowing costs, faster inflation, and the erosion of its financial leadership. This is a high-stakes game. Washington is clearly defending its position, but China is no longer acting alone. A growing coalition of countries is rising against the dollar. Together with its allies, China is building a new financial alliance capable of posing a real challenge to the dollar, and that alliance is called BRICS. It has already become a serious threat to the United States' global position. This economic bloc is building an alternative financial system in which the dollar is no longer necessary. BRICS is developing its own blockchain-based digital currency, called UNIT, intended to replace the American SWIFT system. Momentum is growing. Transactions in yuan and rupees increased by 15%, between the years 2024 and 2025, according to Reuters. Russia and India are already conducting oil deals in rupees. The dollar plays no role in these transactions. Of course, the path is not without obstacles. China carries significant debt, Brazil's markets remain unstable, and BRICS still lacks a unified official currency. But despite these challenges, the movement is gaining traction. Even Saudi Arabia is considering selling oil in currencies other than the dollar, something that seemed unthinkable just a few years ago. If BRICS succeeds, the dollar will lose its central role in global trade. Demand for the American currency will decline, import prices will rise, and consumers will bear the brunt of the burden. This is not just a currency shift, it is a change in the global balance of power that will directly affect your financial future. And now, even the most trusted US asset is beginning to crack. For decades, US Treasury bonds were considered the safest place to store money. Governments, banks, and investors around the world relied on them. But in the year 2025, that trust is rapidly eroding. The yield on 10-year US Treasury bonds has climbed to 4.5%. That may not seem high, but it is actually a warning sign. In a healthy economy, such figures signal trouble. Rising yields mean falling demand. Investors are turning away, and the US government must promise higher payouts just to attract buyers. According to the latest data, investors have already dumped over $60 billion in US stocks and bonds this year alone. But why are they fleeing? Because debt is spiraling out of control. It has already surpassed 124% of gross domestic product, and trade tensions, intensified under Trump, have only added to global anxiety. Even long-standing holders of US debt, like Japan and China, who together own $1.8 trillion in treasuries, are now openly discussing the possibility of selling them off. Such a move would be catastrophic, and one of the main drivers of this unfolding crisis is Trump's aggressive tariffs. Despite new trade deals and loud announcements, most of the tariffs remain in place. They continue to hit Americans' wallets every single day. In June of 2025, inflation rose to 2.7%, up from 2.4% the previous year. That may seem like a small increase, but the real issue lies behind the numbers. Tariffs are quietly but steadily pushing up prices on essential goods, clothing, electronics, food. Some items have risen in price by nearly 20%, and people feel it. According to JP Morgan, the probability of a recession has now reached 60%. Corporate spending fell by 4% in just the first few months of 2025. Consumer confidence is at its lowest level in 2 years. People are buying less, companies are pausing hiring, and retail sales are declining. And what about the Federal Reserve? It is stuck in a deadlock. If it keeps interest rates high, the economy could grind to a halt. But if it lowers them, inflation may spike again. Every move now carries new risks. Wages are failing to keep up with rising prices. Jobs have become unstable, and businesses are bracing for impact. On a global scale, the picture is even more troubling. The world is not just watching, it is growing frustrated. US trade policies, ongoing tariffs, and unpredictable leadership are generating increasing backlash. And it is no longer just rivals pushing back. Even longtime allies are beginning to distance themselves. So make sure to subscribe to the channel so you don't miss what comes next, because this story is just beginning. See you in the next video.